Let me ask you something uncomfortable. If someone truly cracks the code to getting rich, why would they need to sell you the code? Not share it casually, not write about it once. Sell it. Think about the logic. If I owned a machine that reliably generated wealth, consistent, scalable, repeatable wealth, why would I dilute my edge by teaching millions of strangers? Markets reward scarcity. Edges disappear when crowded. So why does the internet seem full of people who claim they found unlimited money hacks and are willing to give them away for $299? That contradiction is where this story begins. Tonight, we are not attacking individuals. We're not doing gossip. We're not exposing screenshots. We're analyzing incentives. Because incentives explain behavior better than morality ever will. Social media millionaires don't need you to fail completely. They don't benefit from you being homeless or bankrupt. They benefit from something much more specific. They need you to feel behind. Behind enough to search. Behind enough to click. Behind enough to buy. Not financially destroyed, just financially unsettled. That emotional middle ground is where the money is. Here's the first critical shift. Most online wealth creators are not selling investing. They are selling transformation, and those are not the same product. Investing is mathematical. Transformation is emotional. Investing requires patience, risk management, probability thinking, time. Transformation requires narrative, urgency, identity shift, emotional discomfort. Which one spreads faster on social media? Which one triggers dopamine? Which one makes you stop scrolling? Here's my diversified portfolio strategy targeting long-term real returns. Or, I went from broke to millionaire in 18 months. One appeals to discipline, the other appeals to desire, and desire scales faster. Real wealth is built on ownership, equity in businesses, cash-flowing assets, compounding returns over decades. But that model doesn't produce daily content. It doesn't generate dramatic weekly screenshots. It doesn't produce visible spikes. Transformation does. Transformation is cinematic, and cinematic stories convert better than statistical ones. The product is rarely wealth. The product is escape from your current identity, escape from your job, escape from your debt, escape from feeling average. And escape is easier to sell when people feel stuck. Social media does not reward truth. It rewards engagement, and engagement is emotional. The core currency online isn't money, it's attention. Attention becomes trust. Trust becomes authority. Authority becomes monetization. But attention must first be captured. What captures attention? Contrast, speed, luxury, outlier outcomes. A modest 8% annual return does not trigger contrast. A rented Lamborghini does. A realistic 5-year business plan doesn't trigger urgency. $27,000 in 7 days does. Flashy wealth isn't proof of financial superiority, it's advertising psychology. Luxury items function as credibility signals, even if they are leased, even if they are financed, even if they are temporary. Humans use shortcuts to assess status.
Even for short-term rentals, humans use these to assess status. A contract makes it official. And the keys? The ultimate shortcut. Because perception is everything.
Status implies competence. Competence implies trust. Trust increases conversion rates. This isn't manipulation. It's cognitive bias interacting with marketing. The penthouse backdrop isn't random. It's positioning. The private jet selfie isn't travel documentation. You are not meant to evaluate the balance sheet. You are meant to feel behind. And that emotional gap creates movement. Movement toward the link in the bio. Now we arrive at the uncomfortable center. If their entire audience became financially literate, patient, and disciplined, their revenue would drop. Not because they're evil, but because the demand would shrink. Financially literate people understand that markets are probabilistic, know that consistent 20% annual returns are rare, value long-term capital allocation, avoid emotional decision-making, don't chase signals. Disciplined investors are boring customers. They don't impulse buy, they don't FOMO into masterminds, they don't purchase secret indicators. They automate, diversify, and wait. Waiting is terrible for sales. Urgency is excellent for sales. If everyone accepted that wealth accumulation takes 10 to 20 years, the accelerated freedom industry would collapse, because the promise of acceleration is the hook, and acceleration only appeals to those who feel delayed. The business model requires a steady supply of people who feel they started too late, believe they missed Bitcoin, think the economy is rigged against them, want to compress time. Not rich enough to stop looking, not broke enough to stop hoping. Hopeful frustration is profitable, and that's the zone the funnel is built around.
Let's break down the mechanics more carefully. Step 1. Entry offer. Low barrier. $49 ebook, $197 mini course, $997 starter program. Accessible enough to impulse buy. Step 2. Motivation plus partial knowledge. Enough to feel empowered, enough to feel like action is happening, but rarely enough to guarantee results, because markets don't guarantee outcomes. Step 3. Inconsistent results. Some people win, most plateau, a few lose. Markets are random in the short term. Step 4. Narrative control. If you didn't succeed, you didn't apply it fully. Which may be true, but it also preserves the system. Step 5. Ascension offer. Advanced mentorship, inner circle, exclusive signals, premium mastermind. Higher price point, smaller group, greater emotional commitment. The funnel doesn't require universal success. It requires recurring engagement. As long as the dream stays alive, the customer lifetime value increases. This is not necessarily fraud. It's structured optimism monetized over time. Now let's talk about numbers. You see screenshots. $120,000 this month, $400,000 launch. But revenue is not profit. Revenue is not retained earnings. Revenue is not net worth. Revenue is top-line inflow. Expenses exist. Ad spend exists. Refunds exist. Taxes exist. Operational costs exist. But more importantly, revenue from selling education is not the same as returns from investing. If someone makes $3 million a year selling trading courses, their wealth came from selling education, not necessarily from trading. That distinction matters, because the perceived expertise may not match the income source. Their true skill may be copywriting, audience building, brand positioning, psychology, not alpha generation. And that's not immoral, but it reframes the narrative. They are not necessarily market wizards. They are media entrepreneurs. Status has always influenced economic behavior, but social media amplified it. In the past, wealth signaled power. Today, perceived wealth generates direct revenue. That's new. If looking rich increases conversion, then looking rich becomes an investment. Luxury becomes marketing expense. Cars become props. Trips become content production. The spectacle funds itself. Spectacle equals attention. Attention equals sales. Sales equals real cash. Cash equals upgraded spectacle. The loop sustains itself. And inside that loop, your aspiration fuels the cycle. You are not being attacked, you are participating. The algorithm amplifies extremes. Moderation doesn't trend. Nuance doesn't go viral. Outliers do. So the system rewards the most dramatic representation of success, not the most accurate one. Let's slow down. This is not a rant. This is not bitterness. Some online entrepreneurs are legitimate. Some built real businesses from scratch. Some teach valuable frameworks. But incentives shape communication, and the incentive structure online rewards strong claims, simplified narratives, emotional hooks, identity shifts, not disclaimers. Disclaimers, not caveats, not probabilistic nuance. That doesn't mean everyone is lying. It means the platform selects for intensity, and intensity distorts expectations. Understanding this doesn't make you cynical. It makes you strategic. The question is not, is he actually rich? That question keeps you in comparison mode. The better question is, what is the actual business model? Does this person make money primarily from compounded investments, business equity, or audience monetization? If audience monetization is the core engine, then the wealth display is part of marketing, not necessarily proof of market dominance. Once you see that, you stop being emotionally triggered. You start evaluating incentives, and that shift changes everything. Social media millionaires don't need you destroyed. They need you striving, because striving people buy acceleration. Stable, patient, disciplined investors don't click urgency funnels. If you build slow, boring, compounding wealth, you exit the and once you exit, you're no longer the ideal customer. That's not conspiracy. That's economics. See you next time. If you want more breakdowns like this, no hype, no drama, just incentives and strategy, subscribe. Because the people who understand the system stop being controlled by it.